Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
On today's episode of Swimming with Allocators, we're blessed to have Diego De Colombres. He's the founding general partner of Dissent Capital, a crypto venture fund of funds based in San Francisco. He's focused on concentrated, high-conviction portfolio of emerging crypto managers. He's had previous experience at venture firms like B37 Ventures, where he invested in blockchain, fintech, and AI, and has a deep expertise in early-stage investing and manager selection in the crypto space. Today, he's going to share with us the disciplined strategy behind Dissent Capital's concentrated crypto fund of funds. Also, how emerging managers can stand out in a competitive and cautious LP environment. And lastly, the evolving narrative around crypto venture, why access is not a strategy anymore. So with that, we welcome Diego.
Hey, Ernest. Thanks so much for the invitation, and glad to be here. Thank you.
Glad to have you. And also missed, one of the most important things is you're a Kellogg grad. So I should have said that, say that with boldness.
Totally. That's our connection. Yeah. Can't leave it out.
See, Kellogg people do venture.
And we're in the Bay, despite the density not being that strong.
Exactly. We're not all in Chicago.
Yeah.
First I would love to, before jumping into Dissent, would love to know about like your background and how you got into this asset class.
Totally. So I'll start with sort of like my passion from finance. I am originally from Mexico, and I always had this passion for finance. The first job out of school was in banking, so I started back at UBS as an equity research analyst covering telcos and transportation. But I wanted to be closer to how companies actually were run and operated, and sort of like thought from a strategic standpoint. So I spent a bunch of my career at BCG, at the Boston Consulting Group, both in the US and Latin America, mainly doing M&A and corporate development jobs. And it was until after my MBA at Kellogg, close to 10 years ago, that I really developed this inkling to, really wanted to explore the technology landscape and getting closer to the inception of ideas and so on. So I made it my life's mission to break into venture capital. And I was fortunate enough to join the partnership of a venture firm in Silicon Valley 6 years ago. So I moved to San Francisco. That's when I joined B37. And basically the model with B37, it operates like a quasi fund of funds in the sense that the investments are direct investments into startups. However, it's a highly collaborative model with tier ones based in San Francisco on the mega funds, in which B37 had a very strong LP bench of corporate partners, and they were a great source of distribution for the portfolio companies and the pipeline companies that these tier ones have. And basically, we would see them at seed, deploy capital at A, and that would be a good inflection point for distribution and so like post-product market fit scaling, right? So as an investor, I was not only underwriting the tech risk of each direct investment, but more importantly, basically how a tier one GP operates, from everything from thesis development to capital deployment and everything in between, even board management and managing the exits, right? So I was doing that at B37, and I was driving our efforts in crypto, AI, and fintech. And how I got particularly and personally involved in crypto dates back, I would say, to 2018, 2019. Being from Latin America, the monetary debasement ethos of Bitcoin resonates naturally. I'm a kid of the 80s, and the tequila crisis of 94, it's still ingrained in the collective subconscious of every Mexican. What happened back then in the 94, it was like a very big macro crisis and debt crisis. The peso devaluated almost 10x to the dollar. We had capital control. So that, the economic freedom, sort of like vision for Bitcoin always was something that drove my curiosity. However, I didn't do much about it until I would say 2018, 2019, when I started to develop my muscle as a venture capitalist and operating in B37. I realized that the intersection of enterprise technology and blockchains as this distributed ledger technology could be massive and could be the next platform shift in our industry. So yeah, I started to develop that view, particularly in the crypto space. And as I continued to hone in my underwriting skills for GPs, I realized, hey, now crypto has matured enough in the sense that there are great fund of funds out there deploying in our space, but we're ripe for specialization right now and really being that platform for new managers that actually carries them over into the maturation of this industry.
There have been a lot of great investors and allocators who come from that background. What do you think you learned and skills that you were able to pick up and kind of shaping how you are as a thinker, as an investor? Like how did those years shape that?
I think equity research gives you a good foundation in terms of like very fundamental analysis of how basically like corporate finance works. And even though the models you use are not necessarily the right abstraction of the reality out there in the markets, it definitely helps you think about, hey, what are the core levers, the core drivers of the fundamental value of a given company? How are they gonna develop over the next 5-10 years? What do I need to believe that will happen in terms of value accrual? And then make an assumption, therefore they should be valued at X today, right? So as I continue throughout my career, I move closer and closer to early stage. I think those models are not as useful anymore because you're, at the end of the day, now underwriting people, vision, qualitative aspects of company building and so on. However, having those foundations are definitely useful about how you're thinking about, okay, the reality in 10 years could look like this. Therefore, I'm going to underwrite my like thesis under this specific framework.
I agree on those points. I think it provides you with a clear understanding, which I think we've lost in early stage a little bit of what is a public company. If that's the aspiration for a lot of exits, do you have the mindset of like what that actually will look like, or what a good acquisition looks like, and does that company or founder have the tooling to actually be able to get there? The other thing is, investing across asset classes is like, there's two main things you're doing, and I think you get a great sense of this in equity research. One is to find truth. Like, so what is the true value of a stock? What's the true value of you're kind of like a journalist, taking in macro, micro, small, qualitative, quantitative information and coming up with like, what is your point of view and your truth? The other piece is being not afraid to come out with your own point of view, because ultimately you're selling ideas as an investor. And so you get real good training on that. So that's enough of that commercial for equity research. But I just found that I haven't been able to talk to anybody else on the podcast about that, but I thought that was fascinating. So moving on, there's great learnings on your background. What inspired you to launch Dissent Capital, though? It's one thing to understand that the world is moving a certain way and you see an opportunity. It's another thing to launch an idea on that.
I think you gave this in the description of Dissent Capital, but at the end of the day, we have certain pillars of how I envision the firm, which is we only back venture vehicles within crypto. We only back emerging managers deploying in pre-seed and seed, and we're running ourselves a concentrated portfolio. So the idea is to have 10, 12 managers, right? So the inspiration, I actually drove the inspiration from Sandana Capital. I think your audience will be very, very familiar with Michael Kim and sort of like his insight close to 15 years ago, I would say, of rethinking how a portfolio of a fund of fund could look like if you really underwrite the emerging managers, simply because you could have a much bigger asymmetry. They're much bigger to select for, right? Because it's much more noisy in that sort of like corner of the market. However, the return profile that you can have, it's quite unique rather than sort of like hedging your bets between emerging managers and established firms. So when I was telling you that I was just completely becoming obsessed with the crypto space and I continued to develop my skill set in underwriting the GPs, I turned around and saw very successful fund-of-fund platforms in crypto already, right? They've been in sort of like in the space probably 2 or 3 crypto cycles, more than 10 years, and they become very successful by following a general approach. So doing crypto, doing liquids, doing emerging firms, established firms, and even more sophisticated strategies like taking GP stakes, for example, right? But to my earlier point, we're now in that point in time in which now going with a verticalized thesis and specialized thesis in, hey, the new generation of managers are coming right now, and you have no idea how dense the sort of like the talent pool right now that we have in the space is. Therefore, if you're expecting as an institutional allocator that a fund of funds that is doing everything is going to underwrite them exactly with the rigor that's required.
I think it's safe to say that the general consensus, and I emphasis on general, so generalist consensus, is that your market asset class is volatile. So what does that mean to have a concentrated portfolio in a market that's perceived as being volatile?
I would say 2 things here. Samir Kaji from Allocate, I think he has a very interesting analysis around diversification from a fund-of-fund perspective. And he has this metric he calls the total, the probability of permanent loss. So basically having a TVPI less than 1. So the risk of not returning even 1x, right? And from a fund-of-fund perspective, if you have one underlying fund, that's around 26% of actually not being able to return 1x your fund of funds, right? Then if you add an additional manager, the diversification kicks in and that probability of permanent loss starts to decrease, right? However, it's not linear. It's basically you're getting asymptotically down to 0, right? So when you hit your 9th investment of an underlying fund, you're actually close to 1% of risk of permanent loss, right? So if you could keep diversifying, yes, you're basically mitigating risk, but at what cost? And the cost is the symmetry, right, of the return profile. So being over diversified in our space in venture and specifically in crypto actually is not the right strategy. That's my perspective, right? Because at the end of the day, if you want to capture the power law outcomes in our industry, you have to have the right exposure to it via the portfolio construction. So that's one thing. But you mentioned sort of like crypto is perceived as volatile. That is true. However, when I think about underwriting managers, I'm more concerned about their own understanding of the cyclicality rather than the volatility, right? Crypto is still very cyclical. It's very dependent on the liquidity and the excess liquidity in the market. It's still very dependent on the monetary policy that's followed by the Fed. And it's still quite tied to the Bitcoin cycle. So your audience might be familiar, but every 4 years, the Bitcoin blockchain, the sort of like the rewards to secure the blockchain get cut in half every 4 years.
That makes sense. And you kind of got into it about what you're looking for in an emerging manager in this sector. Could you go into how you identify them and your selection process?
Just to give you some numbers, Messari, it's a very good research platform, keeps tabs of sort of like who's investing in the space. And we have like around 1,100 firms investing in crypto. I would say half of them are venture vehicles and around 250, 300 are investing in pre-seed and some later stage as well. But I would say like 200 of those venture firms are within so like our parameters, which are funds 1, 2, or 3, and they are deploying small funds, concentrated portfolios, and so on. So we try to meet with as much as we can, and what we're looking for is those new firms and new GPs that have a verifiable right to win, right? They have an insight and they're running with that insight. They're reflecting that unique insight into the firm and the fund that they're building. And that's reflected also in the portfolio construction that they are set to execute, right? And really, what I think it's critical, our industry is so mimetic and narrative driven that independent thinking becomes paramount, especially at the pre-seed stage, simply because that's where basically the inception of use cases and thesis development happens, right? So you really want to skew towards someone that has that independent thought process. And at the end of the day, also, what we're looking for is that early signal to downstream firms, right? Because you're thinking about 20, 30, $40 million fund one or two, they're going to be probably deploying everything, all that capital in first checks. So you do want those relationships of the mega funds and the multi-stage funds to actually consider them like the alpha for their deal flow.
Can you share a story about a manager who impressed you and what stood out?
Yeah, definitely. One firm I really like is Fractis. The founder and managing partner is Jave Megan, Australian guy. And yeah, I met him beginning of the year and we hit it off. I think he fits that profile of what I was telling you about. $20 million fund one. He, before spinning out and raising his own fund, he led the venture team at Course One. Course One is a big liquidity provider in the crypto space. So think of it as a very large operating company. He ran the venture playbook there and had a phenomenal track record there. And yeah, very sort of like opinionated, top-down view, very diligent, very robust technical team that he's built around him, and very sort of like nuanced thesis that he has around infra, middleware, and AI in crypto that I think are sort of like the pillars of what the space could look like in the next 5 years, I would say. And to my earlier point around him being source of early signal to the downstream firms, we reference check him with founders, with investors, and yeah, he's just a low ego guy and a hustler that is bringing basically a fresh perspective to the space.
I love that. And all those things are needed not only in crypto, but in other asset classes too, and other sectors within venture. I've heard you say that access is not a strategy. Can you unpack that for our audience?
If you think about sort of like the prior instances, I would say the 2017, 2018, 2020 vintages in crypto were phenomenal, right? And it was still the industry understanding how the market structure was going to be defined. But so basically, if you were indexing the space back then, you had an outperforming portfolio. That was it, right? So the beta play was actually a very good play. Now, obviously, with the returns and how sort of like the liquidity profile of crypto attracts and is attracting now more and more institutional allocators, well, we now see like a much more competitive landscape of managers, of allocators, of builders, and so on, right? So the opportunities are not as obvious as they used to be. So that's one thing. So a beta play on the space is not a winning strategy anymore. That's one thing. And the other is you might have the access, right? You might have an exposure to a breakout project or a breakout manager, but if you don't have the sort of like the intentionality behind portfolio construction, again, you're not going to capture the power law outcomes of venture and specifically of crypto venture, right? So that's why that's the value add that we bring with our specialization ethos is the emerging managers that are going to be in the early stages, they have the best return profile. Now, again, it's very noisy in that corner of the market. So by engineering our firm around selection, I believe we can systematically tap into the top decile of that cohort.
That's interesting. And it takes a focus on your process, but then also leaving room, as one of our guests said once, leaving room for creativity as well, because you don't want to miss something.
Yeah.
So it's clear that you're being intentional about that. Now we're going to take a quick break to speak with our sponsor.
Hi, I'm Jeremy Rich, Senior Vice President on the Catalyst 2045 team at SVB, a division of First Citizens Bank. For over 4 decades, SVB has been the financial partner of choice for the innovation economy. We understand the unique needs of founders, fund managers, and investors building in fast-moving, high-growth sectors because we've been there every step of the way. Through the Catalyst 2045 team, we work closely with venture firms and institutional investors to help them grow their platforms, raise capital more efficiently, and unlock new opportunities across the venture landscape. When you work with SVB, you're not just getting a bank. You're gaining a partner with deep sector knowledge, extensive networks, and tools to help you scale. We're proud to support Swimming with Allocators and the people shaping the future of venture.
And now back to our LP interview.
What do you see as the biggest mistakes crypto GPs are making in their fund structures and their fund raising strategies?
I think that when they get creative with fund structures is actually detrimental to their own journey, right? And I'll give you some context here. If you think about the nature of crypto venture, you have the company building ethos and the milestone-based funding of traditional venture capital. However, you have a different liquidity profile, right? Because rather than waiting, 10, 12, 14 years to go public via an IPO and M&A, a project might raise a private round, a couple of private rounds, and then launch a token to incentivize the community to get participation in that specific project. And it's a very interesting value accrual mechanism that helps catalyze network effects, right? So that's the beauty of crypto venture. You have the massive outcomes, but with a much attractive DPI profile, right?
Yeah.
However, if you are superimposing an artificial fund structure, to capture that early liquidity via the fund structure itself, I think that's when you get into dangerous territory. So the reality is that in traditional venture, we had this 10-year duration because that's basically how you incentivize folks to think about company building and the long-term, basically shooting for the fences, right?
Yeah.
What I've been seeing in crypto is a bifurcation on GPs. Some of them, the ones that are truly subscribe to that company building mentality, and the other ones that are frankly, I think they're being pushed by a certain archetype of LPs that are underwriting crypto venture as a different asset class and basically saying, hey, if you're able to capture early DPI, go capture it and have a fund that lasts 5-6 years. I'll give you 2-year extension, but then get incentivized to capture their liquidity. But then you start to see that the founders then get GPs that are pressuring them to launch a token when it's not necessarily the best for the long term, the long run outcome of that specific project.
So how do you think LPs should assess the risk reward of crypto venture today?
Well, first I think let's put aside if you have a specific view on the technology, right? If you believe that this can be transformational for many instances and many use cases in the technology landscape, right? Basically, as an LP, you're in crypto venture because you expect bigger asymmetry and a better liquidity profile. So I think that's how they should assess it, right? You're expecting higher MOIC than in traditional venture and a quicker DPI. Now, I believe that is true if you're investing in pre-seed and seed. If you take a look at the multi-stage firms in crypto, the mega funds, they're raising, my belief is they're overcapitalized. And then they have to invest in the later stage rounds in crypto are so expensive. And there's so much overlap within the portfolio of the mega funds that if you're an LP sitting on the sidelines, you might be thinking, hey, are they really paying the right price? And am I getting the right exposure to that venture outcome? And that's what I think LPs should really assess is your crypto, which is highly volatile to your earlier point, which is highly cyclical, and where a lot of it is, driven by narrative. Make sure you're sort of like having the right exposure in the form of the portfolio construction, the liquidity profile, and basically how your underlying investments are deploying capital into the space.
Yeah. So you've decided to focus on pre-seed and seed managers. Could you explain why?
Yeah. I think it's where the best return profile is from a venture standpoint. That's one thing. And the other, I think it's where the industry is driving the innovation forward, right? There's a really good book by Chris Dixon. It's like an entry book to our space. It's called Read, Write, and Own. And there he describes, this concept is not his, but he described what skeuomorphic technologies are. And basically, skeuomorphic technologies are when there's a new technology shift, we are sort of like anchored to our understanding of the prior technology paradigm, and we start thinking about the use cases under that same paradigm, right?
Yeah.
So an example is when blockchains became more well-known, folks started thinking about, hey, how would a decentralized Uber or a decentralized Airbnb would look like, right? And that's nice, but that's thinking skeuomorphically, right? And when the technologies start to actually create new primitives, that's where the development of new use cases start. And it's not anchored on what was the old technology, but then what could the value get unleashed under the new parameters. And that's what's so exciting about pre-seed and seed, because that's where GPs are developing their sort of like the thesis of how the space is going to evolve, and they have the flexibility and space to be backing the founders with the craziest ideas, right? So yeah, the multi-stage firm might come in a Series B to actually back that project, but when they're already showing sort of like early signals of scale velocity, but you're capturing a lot of the value if you're playing in the early stages.
Have you seen the same, I would say, in the generalist or enterprise or consumer venture worlds? We've seen a lot of competition and emergence of a lot of firms go down there. Have you seen a similar trend happen with crypto firms?
I would say that there are very large firms stepping in and leading in seed. I don't think they can go as early as pre-seed, but it's hard, right? Because at the end of the day, the same dynamics that happen in traditional venture, you have them in crypto venture, which is what's the opportunity cost of writing a small check, deploying out of $1 billion fund, right? So it's not in their best interest. Yes, you have the biggest asymmetry there, but they have to put so much capital to work that it's it's a tension for them, right? So yes, it's something that catches their eye and their attention, but that's the natural fit.
What trends have you really excited about crypto?
Yeah, there's a handful of them. I probably heard that stablecoins are the killer app in crypto, and they are. Like I believe they truly are. You see in regions like Argentina, Latin America, Africa. If you think about Argentina and the capital controls and FX controls that they had before Milei, like the inflation was so rampant that you would get paid and your income would erode within the same month, right? And they could not dollarize because they had FX controls. If you have a US dollar-based stablecoin, you immediately get rid of that for like debasement risk, and that's why we're seeing so like strong adoption of stablecoins everywhere globally. And it's a way for the US to export the dollar. I think that's going to extend the dollar hegemony that folks were a little bit hesitant with crypto initially, and now they're realizing that it's actually a great lever for the U.S.
Interesting.
to continually cementing the leadership from a monetary perspective. However, stable coins do not necessarily accrue value to venture capitalists because at the end of the day, they're pegged 1-to-1 to the dollar. But they're an incredible sort of like mechanism, and a lot of stablecoin tooling is sort of like venture backable. So a lot of the tooling there, it's going to be quite interesting to see how that develops. This is a little bit of a cliche, but the intersection of crypto and AI, it's super exciting, right? Because AI is becoming more and more pervasive, but I see the two in a very symbiotic relationship evolving because at the end of the day, crypto is a great guardrail for AI. If you think about in an agentic economy world where a lot of our activity might be delegated to agents, well, proof of personhood, it's going to be critical, right? Crypto is uniquely positioned to do that. And then you have to bring on-chain identity into the real world.
Is there any? I'd assume like your LPs that you have investing in you can come from all different places. What's kind of the archetypes that you sought after?
I would say it's a combination of several archetypes. I mean, family offices, some strategic LPs like CVCs that are in financial services that, you know, they already have a digital assets team. They already have a venture-like vehicle investing in funds, and it's just the next evolution simply because, you know, crypto is so adjacent to financial services that it's for them a good strategy to keep a pulse on what might be coming for their business or what might be complementary to their business, right? I mean, at the end of the day, all these strategic players have a CVC because they want to avoid the innovator's dilemma. As simple as that, right? So that's one thing. But yeah, from a purely sort of like allocator perspective, I would say the archetype of LP that I found that has found more resonance is the ones that are pursuing the traditional endowment-like portfolio, but they're starting to see crypto as the missing sort of like driver. They might already have exposure maybe to Bitcoin, maybe to an ETF. They already have a significant and robust portfolio around venture, and they're missing the in-between, which is exposure to the builders of the blockchain technologies and the blockchain sort of like building blocks that they already have in the venture space. And initially, some of these conversations might take me to a discussion about, hey, I might already have crypto exposure by the underlying investments of the traditional venture firms, right? However, as we've seen in the past 3 or 4 years, I think the crypto native firms are much better positioned to actually have the right deal flow, be picking the right breakouts, and actually creating the portfolios of the breakout startups that make each vehicle the best return profile from a allocator's standpoint versus a generalist fund that might have 1 or 2 crypto investments.
What's one lesson you've learned recently about navigating in this market?
What I mentioned earlier, that our industry is so much narrative driven, right? So coming November, post-election in the crypto space with a much clearer regulatory path on how the industry might evolve, everyone was talking about, hey, this is going to be an incredible bull cycle. You know, capital is going to be everywhere. And the reality is, no, LPs continue to be measured. Obviously, the macro environment right now is still uncertain. That affects crypto as well. But, you know, just being measured and being cautious about when folks get euphoric, right?
Yeah.
Now, the good thing about crypto venture is when you hear about LPs saying that, hey, we have the denominator issue, venture has not given distributions back, so we are over allocated to venture and so on. Crypto venture has actually been one of the few asset classes that has given distribution back to LPs in the past cycles, right?
That is true.
So that's great, because at the end of the day is, if that's the case, why you're not allocating, well, this is an opportunity for you to actually get distributions quicker. And if that's not the case, then it's a great asset class for you to be in, right?
Yeah. I love that. That's a great. Hey, you all say you want DPI.
Here's
We
DPI.
provide. We've provided it. If LPs or GPs want to learn more about Dissent, what's the best way for them to contact you?
Yeah, definitely. I think our website, it's dissentcap.xyz, and you'll see my contact information there, and feel free to shoot me an email.
Great. Well, Diego, it's been a blast getting to connect with you. Always learning when I'm talking to you, and I'm sure our audience learned a ton as well. To see it's not so scary coming into crypto when you got great Sherpas and guides like you.
Really appreciate the kind words, Ernest, and yeah, looking forward to being back in the pod again if you'll have me. Thank you so much.
Absolutely. Thanks for being on.
All right, thank you.
See you later, allocator.
After Portfolio Tile, investing with a smile.